Welcome everybody. My name is Bill Omi, and I'm going to be your host tonight, and we're going to talk about a little bit of training. So last meeting was an intro meeting to give you an introduction to our group. This is actually a little glimpse behind the education. So we're going to talk about velocity banking. I'm Bill Omi. I'm an investor, I'm a coach, I'm a lifetime student, and most importantly, a value creation expert. And you can see some of my houses and little pictures around the screen. Okay, so why should you guys even listen to this? Well, because the guy who's talking to you is a full-time investor and a value creation expert. I've been doing it for 16 years, and I've completed a couple of deals. I own a couple of properties, and I've made a couple dollars doing this. And the business that I've been running in real estate was unaffected by the 2008 crash. Isn't that unusual? In fact, I bought some of my best properties right after the crash when the banks were desperate to get rid of them. I'm waiting for the next crash. And if you're not realizing 30 to 50% a year cash on cash annual returns on your rentals, well, maybe you should listen up. And finally, I'm an honest guy. I don't have a trail of tears in my history, so you're not going to find bankruptcies, lawsuits, foreclosures, drama. Ask my wife. I'm a pretty boring guy. So, who here, let's ask this question, who here is not a real estate investor? So if you're there in front of your computer, if you're not a real estate investor, raise your hand. Okay, so I'm looking at you. Do you live under a roof? Do you sleep in a house with a door that locks? Guess what? You're a real estate investor. Everybody here is a real estate investor. It just might be you're on the not so lucrative side of the deal. Right? You may be renting one of my houses rather than owning a rental house. So congratulations, we're all already real estate investors. Now, let's talk about financial efficiency. Let's talk about your velocity of money, how you handle your cash flow. Most people have low financial efficiency. This is the majority of the world. Okay, this is their life. This is their cash flow. 33% of it's going to go to taxes. Congratulations. Another 33% of it is going to go towards interest to the banks. Folks, the banks, the banks. And then finally, only 33% is going to be available for your lifestyle. And a lot of that will be eaten up by necessities also. So this is a typical person with a low financial efficiency. What wealthy people have figured out and what they teach their children is, let's change the way that our cash flow is distributed. What they do is they limit their taxes to about 10% of their cash flow. They limit their interest to about 10%, and that leaves 80% of their cash flow to be available for their living. And then once they have this configuration in the pie chart, then they start working on increasing their cash flow. Because it doesn't make sense to increase your cash flow if only 33% of it's going to you. So you've got to take care of taxes and interest. Now tonight, we're going to talk about interest. We have other classes and other seminars that will talk about your taxes. But let's concentrate on interest tonight. Okay, Rodanis Velocity Banking Strategy. Now, would you like to pay off a 30-year mortgage in 7 to 10 years? Would you like to pay off those installment debts much quicker than the schedule the banks have you on? How would you like to pay off student loans, car debt, any type of installment loans much quicker? How would you like to save hundreds of thousands of dollars in interest over your lifetime? Could you find a better use for that money, or can the banks find a better use? And at the same time, which almost seems impossible, increase your monthly cash flow. Lower your interest payments without refinancing. Most people think the way they're going to lower interest is to refinance. Refinancing is the last thing you want to do to pay off debt. And while you're doing all this, improve your credit score. Because your credit score affects every cost in your life. You would not believe the areas where your credit score actually affects your life, either advantageously or, I can't think of the other word, went out of my brain. Okay, and do all of this with your existing budget. Well, if you'd like to, then let's get started. Okay, so this actually is important because here's some common banking principles. So I got to do a little bit of homework first before we go into this. Loan interest, all the interest that you owe to a bank is accrued and compounded daily. So the bank takes a snapshot of all the outstanding loans you have and boom, they charge you interest for the day. Now there's two types of debt instruments that banks use. You're all familiar with loans, but there's also lines of credit, and not as common as loans. Now, you can make payments, but not withdrawals to loans. So if you have a car loan or you have a mortgage and you make your payment at the first of the month, can you go get the money back? No, it's like one way. It's low velocity. There's no more motion. But you can make payments and withdrawals from lines of credit. You can have money going in and money going out, money going in and money going out. That's high velocity. Now, loans tend to have fixed interest rates. And lines of credit tend to have variable interest rates. So you have to understand how this all works. Now, the strategy I'm going to show you, Fortune 500 companies use this as a matter of fact. They've done it for years. And other homeowners in other countries have been doing this for over a generation. So let's take an example of Australians. They do this over in Australia. The average Australian pays off their home in 5 to 7 years, where the average American has debt for 50 plus years. Is that not criminal? Why? Because we're taught to refinance. Refinancing is the worst strategy to pay off debt. Okay, so how does this work? Well, the moral of the story here is your cash flow is worth a fortune. The question is, are you capturing that fortune, or are other folks capturing that fortune? So let's look at what most people live their lives. They have a checking account. Everybody can get a checking account. At least most people can. And what do? Their earned income comes in the checking account, and out of the checking account, they pay their expenses and they pay a payment on an amortized debt, right? Installment debt, whether it's a house, whether it's a car, whether it's a boat, whether it's a student loan, we get it. Okay, this is poor cash flow. It's low velocity. Who benefits from this model? Well, Wall Street, the banks, the corporations, and the government are the ones who benefit from this model. But this is what most people do, and they wonder why they're broke. This is most people's lives today. But if you learn what we're teaching here and you know what wealthy people do, wealthy people, they operate out of a line of credit rather than a checking account. And the same earned income comes in, expenses go out, monthly payments to their debt goes out. But there's one other component. They use the excess money in the line of credit to make periodic principal payments to their installment debt. Then what do? That's high velocity cash flow. Then they work on getting passive income so that that line of credit has much more velocity filling up. Okay, and that's passive income. Who benefits from this model? Well, you do. You cut out all of those parasitic elements in the top model, and it's your benefit. So this is your life tomorrow if you learn how to do this. Okay, so let's take a look at paying off debt. This is an example of a velocity banking calculator that I built, and there's 4 different versions of how you can pay off debt. So the first one, the blue box, this is what everybody is taught. So let's take an example of a $280,000 mortgage. Okay, interest rate is 5%, and it's a 30-year note, 360 months. If you do what the banks teach you to do, congratulations, you'll pay it off in 30 years, and you'll pay $261,000 in interest. You'll pay over $250,000 to the banks. Congratulations. Now, the gurus on the radio, right? Oh, we'll make an extra monthly payment. Okay, you could make an extra monthly payment of principal. So in this case, let's say you paid an extra $300 a month. Well, you'll pay it off in 20 years, and you'll save $89,000 in interest. That's good. There's only one problem. Remember I said that you can put money in, but you can't take money out? from a loan. So if you need that money back, if you make those extra principal payments and you break a tooth or your car breaks down, can you go get the money back? No. Now you got a cash flow problem. So now you look at our basic velocity banking. If you use the model I showed, the block diagram just before that, in this case, remember I said cash flow is everything? We're making an assumption that in this person's life, they have $1,000 a month extra in free cash flow. So their total income minus their expenses is $1,000. They could be putting it in a savings account or a piggy bank. If they have that number, just by using their cash flow differently, they will pay off that note in 13 years and save $155,000 in interest. You starting to like it? Okay. And if you really understand what we're teaching and you use the advanced version of this technique, you will actually pay off your mortgage in 11 years, save $190,000 in interest. You're only going to pay $70,000 in interest. But here's the really remarkable part. Your cash flow will actually jump. You'll have more available cash flow despite the fact that you're paying off the debt at a record clip. And look at the bottom here where it shows you the cost of the education. So the essentials, which teaches the green box, it's a $2,000 investment. You're going to save $155,000 in interest. That's a 7,600% return on investment. Folks, can you go anywhere and get a 7,600% return on investment? No. You don't have to do a fix and flip. You don't have to do an apartment building. You don't have to deal with tenants. You just get yourself out of the hole that you and the banks have dug for yourself. And if you learn our advanced program, which now you're going to start using this program to do rental or cash flowing properties. So not just get yourself out of the hole, now build your empire. And that's a $20,000 investment. You'll have an 851% return on investment just for the education. Okay? And why is that line sawtooth? Right? All the other lines are smooth. Why is the green line sawtooth? Because that shows those periodic payments. That shows those chunks of money going in. You see that? It actually shows it on the curve. Okay. So let's go look at the numbers behind here for all you number type people. This is just an amortization chart right from that calculator that I showed you. So this is a 30-year AM chart, and in month number 1 you have $280,000. If you make 4 years worth of payments at the bottom, you'll have paid it down to $262,000. Okay, congratulations, after 4 years you've paid off $17,000. But you've paid $76,000 in payments, and the balance is interest. Now, if you use the velocity banking system, you start off with the same $280,000, but here's those payments, right? Here's that line of credit where you're using the velocity of the money to cover the debt. So at the end of 48 months, instead of only paying off $17,000, you paid off $72,000. Starting to like this yet? Now, let's go farther down the chart. So let's go to month 126. That's 10.5 years. Under the old way that the bankers want you to run your life, you will still owe $224,000. After 10 years, you've only paid off, what, $55,000? Whereas if you're using the velocity banking, where you're parking your money into that line of credit, you'll have paid it down to $70,000, and you only owe $70,000 after 10.5 years. And finally, in month 157, under this scenario, you still owe $206,000. Whereas under the velocity banking, guess what? You're paid off. And now the world is your oyster. Okay? So the question is, do you want to go the old way? Or do you want to learn how to beat the banks, how to actually use the bank's money to pay off the bank's loan? How cool is that? Okay, so here's the requirements for velocity banking. First of all, you've got to have some positive cash flow. If you're making $1 more than you're spending, you're good. If you're spending $1 more than you're making, you have a bigger problem. It's called you're going broke. But we can still help you, because if you saw from the last presentation, we actually have an income opportunity where you can increase your income, hence your cash flow, and now you can take advantage of velocity banking. Now, a good credit score is preferred because you'll have more options, but if you have crappy credit, you can use the classes and the essentials to actually improve your challenge credit, get your credit score up, so then you have more options. But you can actually do this with lousy credit. Can you refinance with lousy credit? Not a chance. And this is just one of the classes in our Essentials program. So we're talking about the Real Estate Essentials, Credit Management, Red Flags class, Tax and Legal 1 and 2, how to self-direct your IRAs, how to find properties at huge discounts, how to control properties under creative acquisitions, real estate marketing, and just velocity banking is the final class. It's only one class that teaches you how to do this. Look at the value you're getting. Okay, and no refinancing is required. In fact, stop refinancing. It's a fool's errand. And you don't even have to have equity in your property. If your property is upside down right now, can you refinance? Not a chance, unless you bring a huge lump of money to the closing table. But you can actually work this system on an upside down property and pay it off at an accelerated rate. How cool is that? But here's the requirement. You must study your classes and attend the coaching sessions before you go off and start doing this. Again, I'm going to give you a 25-minute overview of a class that's 8 hours long. So don't go out and do anything financially irresponsible. Okay, so what are the benefits? Well, the benefits are to get out of that crushing 33% of your cash flow going to interest. So you're going to save hundreds of thousands of dollars in interest over your lifetime. You're going to pay off installment debt at a record pace. Now, here's the cool thing about lines of credit. You can make payments to and withdrawals from. So let's say you're on that program and your car breaks down or your child needs braces and you need an extra $5,000 or $10,000. Can you get the money back? Yes, because you can go to the line of credit and draw it down for your needs. Now, yes, that will slow you down by a couple of months to pay off your debt, but you have options. And the banks like this. If the banks see you doing this, that will improve your credit score. And you'll be surprised because the lenders will want to increase your credit lines. Because now that you have equity, they're like, wow, you have equity? Hey, let's increase that credit line. Here's something really interesting for advanced folks, especially investors. Lines of credit payments can be immediately withdrawn. If you make a payment on a mortgage, or if you don't make a payment on a mortgage, you're in default. If you have a line of credit, and let's say you owe $500 for the month, you can make the $500 payment and the next day pull it back out. And it's considered a monthly payment. Do you see the power of this? Do you see the options that that presents? And line of credit utilization rates are usually not factored in when calculating credit scores. Banks don't look at lines of credit like other installment debt or credit cards. They look at it differently. And you always have access to your funds by drawing down the line of credit. So you're going to learn not only to get the big debts paid off, but the student loans, the credit cards, and then use this model for your investment real estate. But now you're not going to use your cash flow. Whose cash flow are you going to use? That's right, you're going to use your tenant's cash flow. How cool is that? Okay, so let's take an example. I want to show you real quick something interesting about this whole velocity banking system. So I'm going to share my screen for a second. Share my screen. I got this. We're going to go over here, and we're going to go here, and we're going to go here and here. And look at this right here. Hold on. I got this. Okay, so here was the numbers I showed you on that calculator, right? Now, what I want to show you is how cash flow is everything. So right here, we're talking about a person who has $1,000 in positive cash flow. Well, let's increase your cash flow. So let's lower your expenses because you're going to take our tax classes and you're going to learn how to restructure your activity, and maybe you save $300 a month in taxes. So right now, we have $5,500. Let's lower that to $5,200. Okay, now watch the numbers. You're sitting at 13.25 years and $155,000. just by lowering your expenses and increasing your free cash flow, you're now down to 11 years and you're at $169,000. But you can also increase your income or your cash flow because we have the Independent Marketing Affiliate Program, our income opportunity, and by helping others. You think there's anybody in your life who could benefit from what I'm teaching you tonight? Who could benefit from learning this concept? So let's say you find one person a month that would like to get the essentials and learn how to do this, and you earn a $1,000 commission. So instead of $6,500 a month, just by working from home, you're now at $7,500 a month. And look at the numbers. You're now paying off that note in 8.5 years, and you're saving $192,000 because your cash flow is increased. And you can see down here, for the $2,000 investment in the essentials, you're talking about a 9,500% return on investment. Folks, wealthy people look at everything as return on investment. It's poor folks that worry about spending money. Okay, so this is the possibilities. And if you learn the advanced velocity banking, you actually will pay that note off in 7 years and save $219,000 in interest. Isn't that phenomenal? Okay, so let's go back. Just wanted to show you how cash flow actually interacts with this. So stop my sharing. Let's go back to the presentation, share my document, velocity banking, and we're okay. We're all good. Okay, so let's move on. Now that you've gotten out of debt, now that you've gotten out of the deep hole that you're dug into, let's talk about creating wealth and passive income. So now you've gotten out of the hole, let's start building your empire. Okay, now let me go over a couple of things here. If you work with your present job, if you guys are still a job person, and you work for 40 years, how much can you sell your jobs for? Well, everybody knows your job's not worth anything. So for 40 years you've built somebody else's business, and you have nothing to show for it. Congratulations. Can you leave your job to your family when you die? No, because job has absolutely no value. Okay, so let's take back control of your life. You're being taught to give and abdicate responsibility to the Wall Street folks, the corporations, the government, right? I need a money manager. Yeah, a money manager is really taking care of your retirement. So let's take back control of your future. Let's learn how to acquire one little cash flowing property per year for 20 years. Well, you're going to create wealth on day one, so you don't have to worry about whether inflation or property prices are going to go up, because you're going to buy the property at a discount. So you buy that $100,000 house for $33,000, you just tripled your net worth with the stroke of a pen. Can you do that with any other of your retirement accounts? No. And you're going to create value. You're going to learn how to create so much value for your tenants that they're glad to pay off the property while the rents and the values adjust for inflation. So how much are those 20 free and clear properties worth? Well, if they're $100,000 houses times 20, that's a $2 million nest egg. Now, how long will it take you to save $2 million? Many people, it will never happen. Now, can you leave your properties to your heirs? Yes, in fact, because wealthy people write the tax codes, you can actually leave huge portfolios of property to your family tax-free. But most importantly, because cash flow is everything, how much cash flow will those 20 properties generate? Well, it's pretty easy to generate $500 a month on a paid-off property. Times 20 properties, that's $10,000 a month. Forever, folks. You're not going to deplete your nest egg. You can live to be 185, and you'll still be taken care of. And then you pass it on to the next generation, and they'll have rich people problems. You'll have to teach your children how to be good stewards of wealth. And do you think there's going to be more or less demand for housing in the future? Everybody wants to get to the U.S. There's been a shortage of housing for years. Huge opportunity. And then what do? You use the velocity banking strategies to pay off the small amount of debt that it took to buy the houses. You see how this all comes together? Okay, so let's talk. I talked about this in the last video, but it's worth repeating. Let's talk about a cash flow-based retirement plan. Actually, let's make it a cash flow-based life plan. So what the average person is taught to do, actually 99% of the population, is to base their lives on assets and liabilities. They focus on what they have. Wealthy people don't care about assets and liabilities. They care about the cash flow from those assets. So if you stick with what you got, you're on a savings plan. Savings, scarcity, fear of loss. You've got to do without. You've got to scrimp and save. You've got to eat beans and rice and beans. And with doing all that, you've got to put away $2.4 million if you're going to live 20 years and you need $10,000 a month. How's that working for you? But the cash flow-based folks know that, look, you can create value. And value creation is infinite. So there's no limit to what you can do. Okay, asset-based folks, most people put retirement money in retirement because they're trying to avoid taxes, because they don't understand the tax system. Whereas wealthy people, they focus on cash flow because, newsflash, we don't tax cash flow in the United States. So your goal is to create as much cash flow as possible and the minimum amount of income. Oh, this is huge. If you're going to stick with the old plan that they've been teaching you, you better have started 30 years ago. Right? You got to start when you're like 3 months old to have enough money to retire. Whereas a cash flow-based plan, you could start in your 40s, 50s, even 60s and become financially independent. This is a huge one. The asset-based crowd, which is most of the middle class, is buying their assets at full face value. This is what Wall Street teaches you to do. You buy your stocks, you buy your bonds, you buy your mutual funds at 100 cents on the dollar. And then you hope that things are going to go up in value. Whereas what wealthy people do is they buy their assets at deep discounts. They create their wealth instantly. They don't have to wait for anybody else to create it. Asset-based folks are obsessed with liquidity. What do? They buy at the top and they sell at the bottom because they freak out when the markets crash. How often does the market crash? Oh, I don't know, about every 8 years, 9 years. Whereas if you're in a cash flow based plan, your cash flow is liquidity. You control the cash flow. You don't need to dump your stocks to some bigger fool when the market's crashing. You just sit back and say, oh, look at all that stuff going on over there. I don't care. Okay, you've got to be old to retire under the plan that everybody's taught. Oh, you don't have enough money at 65? Well, maybe you can retire at 70. Maybe you can retire at 72. Yeah, unless you die a year before you retire, and then the joke's on you. But under cash flow base, you retire whenever you want. Once your cash flow exceeds, once your passive income exceeds your expenses, you're done. Now you can concentrate on fun things. Here your nest egg's being depleted. Here your portfolio is growing. You never affect the nest egg. You let the golden goose keep cranking out the eggs. You're controlled by Wall Street under the present model, whereas you have control of your program under the cash flow based model. Do you guys see the difference? When I figured this out, I was like, oh my goodness, everybody's got to know this. Okay, so once again, this little house of mine is worth over $500,000. Can you believe that? And no, it's not in Central Park. It's in rural Georgia, and I paid $28,000 for it. Now, how can a $28,000 house that's worth $80,000 now be worth over $500,000? Well, because if you had $500,000 in the bank right now at 1%, you'd be earning $416 a month in cash flow. Congratulations. But that little house, which easily rents for $650, will yield over $500 a month. So the house produces more cash flow than $500 grand in cash. But it gets better. The $500 in cash, because this is what middle class people are taught to save assets, it depreciates. Cash is not what you're looking for. What you're looking for is cash flow. So inflation every day of the year while you're sleeping is devaluing your nest egg. Whereas the property, because it reflects the the depreciation of the currency goes up in value. And you couldn't buy the $500,000 at a discount. In fact, you may have paid taxes on it and had to pay, oh, who knows, 20-30% of taxes, earn $700,000 to actually have $500,000. Whereas you can buy little properties like this for pennies on the dollar and triple, quadruple your wealth on day one. And again, financially inefficient people concentrate on taxes, whereas financially efficient people concentrate on write-offs. Because the government encourages certain behavior, and one of the things they encourage is job creation and housing. So you might as well take advantage of it or be a victim of it. And then finally, you get to use the velocity banking strategy to pay off those properties. So you guys seeing a trend here? Okay, why didn't I learn this in school? How many of you guys are getting mad? How many of you guys are shaking your head going, man, how come I didn't learn this? Because you're not supposed to learn this. In fact, college graduates, even MBAs, don't learn this. I've got 3 college degrees. I didn't learn it. Okay? You're taught by employees. Your professors in your schools are employees. They're not business owners. So you're taught by employees to be a good employee. What are you taught to do in college? You're taught what you need to do to get a job. Not create wealth and become financially independent, to become a cog in the wheel. And the banks earn billions of dollars from this 30-year mortgage refinancing nonsense. So the banks are making a fortune off of your cash flow while you're wondering why you're always broke. And then what the banks don't make, the Wall Street guys make billions managing your money. Because you're taught, oh, you're not smart enough to handle your own retirement. Oh, really? Oh, really, Mr. Bankers? Like you care about my retirement by skimming money off of my retirement every year. So your teachers, your parents, your role models were most likely W-2 employees. So they just didn't know what they didn't know. And your government collects much more taxes from financially illiterate workers. So your government does not have a vested interest in educating people to understand the system, because they collect a lot of money. And here's a perfect example of it. Most students nowadays, I mean, talk about a crime. Most students today graduate deeply in debt due to student loans. And did you know that student loans are one of the only debts that's not extinguishable by bankruptcy? Think about it. AT&T or IBM can bankrupt away billions of dollars and start over the next day. Whereas if you're a student and you have a student loan, the only way for you to get rid of student loans is to either pay them off or die. How about that for rules? But what happens? The banks are guaranteed their money. So you can see how this works, and that's why your tuitions are so high, because the banks giving out all of this free money to the students allow the colleges to just raise their tuitions exorbitantly. And I got a button for you. I'm broke and I have a degree to prove it. How many people do you know that have bachelor's degrees, master's degrees, even PhDs, and they're struggling? And they're working at Starbucks. And they're living in their parents' basement because they don't understand the system. They're a victim of it. Okay? So, you don't know what you don't know. That's why we're here. Okay, so who could benefit from all this knowledge? Well, you and your family, graduates. Boy, if you've got any students with student loan debt, everyone who has debt. By the way, pretty much everyone has debt, right? Realtors and real estate professionals. Look, if you're a realtor right now, could you imagine at a closing table, instead of saying to your buyer, saying, hey, congratulations, Mr. Buyer, on that new house you just bought. Call me in 7 to 10 years when you want another one. You could say, hey, congratulations on that new house that you have, Mr. Buyer. Oh, you know that big mortgage that you just signed for that you're freaking out about? Hey, call me tomorrow and I'll show you how to pay that thing off in a fraction of the time and save you a couple $100,000 in interest. You think you might be like a super realtor if you could do that? Come get our classes. Mortgage brokers and lenders. Guys, the refinancing binge is over. Interest rates aren't going any lower. So a lot of mortgage brokers have been making a living for the last 20 years refinancing their same clients. Well, between that and Rocket Mortgage, they're going to lose a huge chunk of their business. Okay, Rocket Mortgage from Quicken Loans is going to do what Travelocity did to the travel agent business. It's going to eliminate 95% of the need for mortgage brokers. How about CPAs, financial planners, tax professionals? How come your tax professionals and your CPAs aren't telling you about this? How come I had to do this presentation? You should ask them, hey, how come you're not telling me about this velocity banking thing? Because they probably don't know. Pastors and counselors. Guys, if you have anybody that's a counselor or a pastor and their whole congregation is struggling because they don't make enough money or they're under debt, could you imagine helping out a whole congregation by showing them this presentation and helping the pastor so that his flock has more money to tithe to the church, so that his church can what? Feed the poor, house the homeless, do all the things that churches do, but they're having a hard time doing because people don't have disposable income. And the first thing it suffers is charities. So you can earn while you learn and help others. Can you think of a better thing to be doing? Okay, so which plan do you want? Do you want the first plan that the banks have you on right now? Good, congratulations. You want to pay $261,000 on that note? It doesn't cost you a dime. You want to go the second route? Great, you can make those extra payments. You might have a cash flow problem, but it doesn't cost you a dime. Do you want to learn velocity banking for a $2,000 investment and save $155,000? Or do you want to change your life and learn how to be an investor, not just a homeowner, and pay off a note in 11 years and save $190,000? That's a $20,000 investment in yourself. So which plan do you want? And let's get you started now.